Good morning, ladies and gentlemen. A huge congratulations is in order to the University of Michigan Wolverines on their big win in the NCAA men's basketball tournament over UConn. Didn't get a chance to watch much of the game, but it seemed like a great game. We'll hear Triple D's thoughts on the game. We're going to definitely hear about Joel's thoughts on the game tomorrow when he's back in action live in pre-market prep. Of course, our updates on the Middle East. The deadline is tonight at 8 p.m. Eastern time. A lot of volatility here in pre-market action right as futures open and into the 6 a.m. hour. We'll get you those updates. A lot of news overnight, including the Centers for Medicaid and Medicare Services Medicare Advantage rates moving the entire healthcare space. UNH, CVS, Humana, several more. Also, a deal with Broadcom and Google. Artemis 2 goes around the moon with a few astronauts. We have S&P 500 editions later this week on Thursday. We're going to get into a few ratings a little later in the show. One of our favorite guests here on Pre-Market Prep this morning around 8:30 a.m., Statman Ryan Detrick will be coming at you and the audience with a lot of good stats, folks. Let's get it going here on this morning's Pre-Market Prep.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. And this is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
These charts, folks, brought to you by TradeStation. Born to trade, chart, analyze, customize, all in one platform. Thank you to TradeStation for being the wonderful sponsor of our charts on Pre-Market Prep. Take a look at, of course, the SPY to start things off, trading down about 0.5%. Qs, why not take a quick look? Sure, let's take a quick look. Qs trading down a little bit more, as per usual, about 0.7%. Oil this morning trading up about 2.5 or 3%, right around the $116 per barrel level. Gold this morning, what are you up to this morning? Gold trading pretty much unchanged, pretty much flat. Silver and the SLV down about 1%. Let's take a look at the TLT. Why not? Haven't looked at the TLT in a few hours. TLT trading down about 0.3%. And the last one, last but maybe least, maybe not least. I shouldn't say that. Bitcoin trading down about 2% here this morning. Thanks again to TradeStation for sponsoring those charts. Let's bring in the Triple D trader himself, Dennis. Good morning, sir.
Yeah. Lots going on this morning. Again, though, congratulations, Joel. Yes, I'm wearing the same shirt that I did yesterday. We were cheering them on, and when they win, you don't take it off. So I watched the game. They had me nervous at the end, man. They were up significantly, and then, the turnover, and then the 3-point shot, and then we got a 4-point game and on the 2 missed free throws, and I'm like, oh, boy, man. I'm like, there's 30 seconds left. Don't blow this, but anyways, obviously, they held on. Nail biter at the end. Congratulations, Michigan. Congratulations, Joel Elconin. He will be back tomorrow. I'm sure he'll have some stories to tell.
Heck yeah.
But
should we get to the market and our Middle East update?
Yeah, we have some stories to tell about what's happened here overnight here. Please tell, Mr. Slava.
And the chart really does tell a story here. Let me pull up my chart. I have it on screen, but I want to zoom in a little bit here. So around 609 right there, if you can see where my little crosshair is, this move lower here, Tehran rejects any temporary ceasefire. That was that one. Little bit of a, juke lower, and then we kind of came back right away. This move here around 626, we heard Cargill explosions. That's what started bringing us down here. I want to jump back to we did hear that Tehran set preconditions for talks with the U.S. on, quote, lasting peace. Some of those preconditions, seems pretty reasonable. Immediate halt to strikes, a guarantee that strikes will not be repeated, compensation for damages, which, as maybe crazy as it sounds, President Trump yesterday in his presser did mention that. He said maybe we will help them rebuild their infrastructure. Iran is also asking for fees for ships passing through the Strait of Hormuz. That's currently happening as far as what we've heard, happening with kind of like this toll booth setup. And then back to the Carg Island explosions at 6:25, which again was right around here. So we just heard like a general explosions on Carg Island. About 20 minutes later, we heard Israel said they were responsible for the strikes. But then right before we started pre-market prep, just about 10 minutes ago, I saw a headline, conflicting reports saying that Israel said they were not part of the strikes. So conflicting reports here. And, of course, this has really been the case for a lot of this conflict, right, Triple D?
The entire time. It's like conflicting reports. I mean, we don't know what to believe coming from our administration and Iran. You don't know what to believe on either side. So really, investors continue to remain overall in the dark, where we can see, when we see explosions happening, when those are getting reported, obviously that sounds escalatory. I mean, it's all about, deal or no deal. That's the name of the show. It's the only thing that matters. I still think you're chopping around in wait and see mode here. It doesn't look to me like there's going to be a deal. Now, the question is there an extension? Is there talks? Or do they just start going up at midnight and start blowing up bridges? I mean, that's going to explode the USO higher, bring the USO on our screen, because it's your tell. I mean, through all the talk, through everything, through all the, okay, yeah, we're close to a deal. We're winding down operations. USO has been steadily climbing higher. It's been calling Trump's bluff. And, now we're at a point where USO is now at a 52-week high again. So we're moving here right now. Something just happened.
Oh, something just happened. Let's see what we got. Standing by for news. Futures are falling. Futures fell about, Futures fell about 20 points, but we're coming back already.
This is just what we have here now, folks. It's like, boom, we've got, boom the other way. I mean, it's all headline driven. If you're trading this market technically, you got to be, it's tough. You can say, well, maybe we'll go to this level or this level, but it's real tough to trade this market technically because, all of a sudden, boom, there's a headline. And then, oh my gosh, here's the tweet. Is this right now? I'm just going to read it. A whole civilization will die tonight, never to be brought back again. I don't want that to happen, but it probably will. Okay, I just stop right there. I'm like, this is crazy tweet. However, now that we have complete and total regime change where different, smarter, and less radical minds prevail, maybe something revolutionarily wonderful can happen. Who knows? We'll find out tonight one of the most important moments in the long, complex history of the world. 47 years of extortion, corruption, and death will finally end. God bless the great people of Iran. The first line in that scares the hell out of you, and then he kind of backs off a bit, and it sounds like, well, no, maybe. So, but the whole first line is scary as hell. And then the rest of the tweet is like, okay, he's taking it back a little bit. So it's like he's changing his mind a little bit in the tweet. So put it back up there again, because this is all we have to dissect. This is what moves the market. This is what just exploded the USO higher here. So it starts. Algos read this, and instantly sell. A whole civilization will die tonight, never to be brought back again. That's the most aggressive tweet we've seen so far. But, he kind of backs it off. I don't want that to happen, but it probably will. So he's wishy-washy, doesn't know if it's going to happen. He doesn't know. I mean, we don't know. He doesn't know. However, now that we have complete and total regime change where different, smarter, and less radicalized minds prevail, maybe something revolutionarily wonderful can happen. Who knows? So that's backing off his first statement. So very aggressive, art of the deal, you're going to die, and then, but make a deal and you won't die. We will find out tonight one of the most important moments in the long, complex history of the world. 47 years of extortion, corruption, death, finally, and God bless great people of Iran. Okay, so this is where we are. It's back to deal or no deal. It's the only thing that matters, folks. You can have the prettiest chart in the world. If they start blowing up bridges over there, your stock's going down tomorrow. If, we get a deal, you have the ugliest chart in the world, we're going to see a rally here. So throw your technicals in the back seat right now. It's all about the headlines. This is the most headline-driven market that I've been in since the financial crisis. The financial crisis was crazy. Well, maybe COVID.
Yeah.
COVID was
crazy.
Headline-driven too.
Yeah.
But, the financial crisis is absolutely crazy with like the headlines, we're like just glued to the TV. What's the next bank that's going to fail? Lehman Brothers is going down. They're
Crazy.
coming to rescue, other banks as well. It was crazy. It kind of feels like that's like where we are. We're so glued to the headlines, and it's the headlines building the charts. I know there's a lot of people say, just use technical analysis and nothing else matters. Technical analysis is one tool in your toolbox. I don't care what the chart looks like right now, man. I'm not even using charts. It's all about the next headline. The headlines are making the charts.
COVID was just crazy for everybody. Financial crisis was like, man, that price action. I remember just coming in to work each day and seeing Goldman's up 20%, Morgan Stanley's down 20%, Morgan Stanley's up another 10%. The one saving grace, and of course I'll go to the chart here right after you said, oh, don't look at the charts, but the one saving grace, thanks for laughing at that. The one saving grace here is crude didn't move a ton. Crude is
up about
modestly higher, maybe a few, a couple dimes. The move in futures was more outsized than the move in crude, and we are looking at futures. We're right around 66.12 here. So all things said and done on that Trump tweet, down only about 4 or 5 points from where we were prior to.
It's scary times, for the people of Iran. It's scary times for, us. Like, I don't know, you keep poking the bear here. I worry about a terrorist attack on North American soil. Like, I mean, there's so many things you can worry about here. Escalation is not good for anyone here. I know there's, obviously, peace talks here, we hope that prevails. But, I almost like the stock market, I feel secondary here. I just feel sorry for innocent people dying here. So this is just, scary. It's scary times for all. And I hope a deal can be made. But, as traders, we have to be prepared for the best and the worst. I mean, in the case that they get a ceasefire for 45 days, even, that's probably going to be the best case scenario because they're not going to have a full ceasefire. But let's say we get a temporary ceasefire. The market's going to pop significantly here. And if we don't, we're going to just start leaking. We have had, let's just bring up the technicals again, because we can tell that there is underneath demand in this market. This market itself, the S&Ps kind of want to go higher, but the headlines are not allowing it to happen. But we have been climbing the wall of worry. It's very impressive. This is where you can use charts. It's very impressive that the S&P is holding up as well as it has with USO making new highs. Because we went to a week ago when USO was making new highs, SPY was making new lows. That has decoupled here to a certain extent. Maybe the market accepting that we are going to have higher oil prices for the foreseeable future. There's going to be winners and losers on that. Maybe they start looking at that as well. But I mean, this is just, where we are with this market here. So headline driven. And, headlines coming all over the place. We can move away from the war for a second and, talk about, the healthcare sector here because random headline coming out. Well, not random. Some people knew this was going to happen, but we got Medicare Advantage rates coming out here last night, and they look good for the healthcare provider stocks.
Yeah, we notice healthcare names start going crazy. We have our scanners that we watch, and like a really easy and simple way to think about this is we saw UNH start moving, and then Humana start moving, and then CVS start moving, and then CNC start moving. When you see that kind of price action, it's a sector-wide piece of news item. Dennis and I were in the STN room last night for the closing bell show, and right when we saw, 2 or 3 or 4 of those names moving, okay, it's not individual news. This is something that is sector-wide news. What's a sector-wide news item that moves the healthcare names a lot? The CMS rate decision. So the Centers for just reading from on screen here, the Centers for Medicaid and Medicare Services released their calendar 2027 Medicare Advantage rates for 2027. This sets rates for all of next year. And the important part to focus on here is this little ditty. The rate announcement are projected to result in a net average increase of 2.48% or over $13 billion in additional MA payments, Medicare Advantage payments for calendar year 2027. Our go-to watch list for this is, of course, I already mentioned a few, but in addition, Molina Healthcare, MOH, ELV, Elevance Health, Cigna, CI, Oscar OSCR started moving a little bit later. It was a little bit delayed. It was maybe delayed a
Yeah,
minute
and
or
it's
two.
not more direct. Like your direct
Yeah.
plays are the UNH, CVS, and Humana. Those are the big three
Yep.
you think about right away, and even ELV. So the big four.
Yep.
And then you get into like the Molinas, MOH. The CNC moves up. CI can move up a little bit, although it never moves quite as much. And then you start to get into some smaller ones. You can go EVH like you have on the screen here. Oscar moved a bit, but then it's kind of giving it back too. So those stocks remain a lot higher here. That's going to help the XLV. The XLV is trading flat. Full disclosure, I'm long a little bit of XLV. Last night, we were trading this, and I think like there's nobody breaking the news faster than us on this one, because I see the movement. All right, I was like Medicare. Like I see the movement like literally 5 seconds after we're telling you what it is before the headline's out there. Then you can see the headline. Then we can analyze it further. But there was definitely some money to be made on that move. Now the question is this a rip to sell? It's been a tough environment for a lot of these stocks, but it's really good news. I mean, Trump was kind of saying the opposite back in January.
Sure.
Why UNH and CVS and Humana all fell significantly. If you look at that big
Great
fall,
point.
you go to your dailies, you can see the gap down here. Now we're getting a lot of that back. On a stock like CVS, we come way back up, to the 80 resistance last night. Kind of fails there a little bit, but you're at 78, still holding on pretty well in a tough tape. So the question is, do these stocks hold on, or do they continue to, just leak? And that's what we've seen is sell the rip has been the best strategy out here in this market this year. Is this another sell the rip opportunity? I think some of them may have overshot a little bit last night. We've already kind of seen a little bit of sell the rip. I mean, good news and a bad tape. It's tough to chase these things. Like that's just it. We've been talking about that. If you're chasing stocks of 10, 12% on news, you've been not rewarded at all, and you've been rewarded with losses. So, I mean, it's been the move is to fade maybe not the initial spike, but once she starts to stall out, then you start to get in there and start to play on from the short side here too. But, so far, so good for these stocks because they are holding up fairly well.
And what a coincidence, Triple D. Nice pointing out the $80 level here in CVS. And then, what a coincidence. You pull up the UNH chart and right around 310. Looks like there's a little resistance. And then you pull up the Humana and right around 205. It looks like you see a little resistance there.
Yeah. Yeah.
All right.
So that's the good news. One thing to consider is that these stocks are so strong, obviously a big part of the XLV. Sorry, still dying.
No, don't die.
Don't die, Triple D. Is you could see pressure potentially on some. The XLV is full of healthcare providers and drug stocks. So the healthcare providers are all going to be super strong. Well, and the XLV is kind of flat. That means they got to hit something else. So I would just be careful chasing a Lilly today. Lilly's barely down, kind of down the market. But I wouldn't be surprised if it shows a little bit of excessive weakness here because it's the biggest component of the XLV. And sometimes you'll see actually that individual rotation within the ETF itself. So, just caution, I would say. I have no position on it, Lilly. But, even Johnson & Johnson is another one that's a big part of the XLV. And if they want to buy those healthcare providers up but keep the XLV down, the way to do it is to sell Lilly and Johnson & Johnson. So keep that in mind. This news can actually pressure these stocks simply because of the ETF effects. We're the only show that talks about that.
What a great little trading idea there, Triple D. Just pulled that out of your magic hat. You're like a stock trader magician, man.
Sometimes I'm wrong too. That's how this works. Right and wrong. Get out when you're wrong. Ride them when you're right. That's how this whole game works here.
All right. Next major news
We're moving
item.
up. We're moving back up here now.
We're moving back up. Yep.
The S&P futures just spiked here.
We have comments from Vance. There are two pathways for Iran. Very shortly, this war will conclude. Vance saying this just now. That seems to be why we are moving higher here.
Amazing. When we've been on the show for 18 minutes and we've had a gap down on the Trump truth and now a gap up on a Vance. This is going to be the day, folks. So, I mean, don't get, too, married to any of your positions here. When you're in a gappy market, a contrarian market, it's, a good idea, especially if you're a short-term trader, to take the profits when you got them because bang, they can just be gone. Like think about even the overnight session. We sold off 30, 40 handles, worries. Then we rallied it overnight. Then we give it all back. I mean, this is now we're spiking back up here again. It's incredible back and forth action here. And, this is the unknown. Even the president is the unknown here right now. He doesn't know how the response. It sounds like it's not going to be a good response. But, this is where we are. So Vance is saying, again, very shortly this war will conclude.
The military objectives
with the obliteration of Iran, that's a question mark there too.
More here from Vance. The military objectives of the Iran war have been completed. So maybe some of the explosions that we were heard discussed by traders was I don't know, maybe the end of it. Seeing a WSJ report right here, right now, the U.S. strikes more than 50 military targets on Karg Island. More from Vance here. Breaking news, folks. This is fluid market. We hope Iran is smart. And if I mentioned futures making an outsized move versus crude oil on the Trump truth, well, now we do have more of an outsized move in oil. Look at this pullback here in oil from over the 116 level. We just fell about, call it $1.50 per barrel on crude oil after that move higher over the 116 level.
Going to be constant tweets, truths, rumors breaking from media sources here all day today. This is the day you sign up for, and if you can't take the heat, set it out. That's what I would say too.
Well said. All right, let's go to a next breaking big news item overnight. We do have Statman coming up at about 10 minutes at 8:30 a.m. Eastern time. Broadcom announcing a big deal here this morning. I'm pulling up the SEC feed. The SEC filing. Broadcom and Google have entered in a long-term deal for Broadcom to develop and supply custom tensor processing units, TPUs, for Google's future generations of TPUs. Also, a supply assurance deal through up to 2031. Separately, Broadcom, Google, and Anthropic have expanded their current strategic collaboration, under which Anthropic, beginning next year, will access through Broadcom approximately 3.5 gigawatts of AI compute capacity. Thoughts?
Broadcom popped on this headline. It was like random news night all night.
Yeah,
even
it really was.
Individual sectors, obviously. The Iran, headlines are one thing, but we had the Medicare news, and then this random news coming out of nowhere from Broadcom. It pops $10 instantaneously on this news. Still holding up fairly well. The ramifications for this, you think Google's, it's up a little bit. Full disclosure, I do have a long position in Google, trading position there, which I'll be getting out of this morning.
Nice.
But also just talking about, like NVIDIA, I think this puts a little pressure on NVIDIA, to be honest with you here. NVIDIA's had a pretty good run.
Look at the chart.
But I don't think this news, remember we were doing the TPUs versus GPUs thing?
Oh, yeah.
I forgot about that. It's on the back burner here. I don't think the markets forgot about it, because NVIDIA's down 1.37% here. AMD also down 1.78%. So usually what's good news for Broadcom and Google seems to be like bad news for NVIDIA and AMD. So just keep that in mind if you're trading these stocks. I still own both of those in my long-term portfolio.
And what about Celestica, CLS? That one popped right when we heard about this, but it has been faded. But yeah, Celestica has been kind of one of the more under the radar, in my opinion, like data center, like especially with Broadcom, when we see data center related stuff with Broadcom, Celestica is kind of one of your first movers a lot of times.
And it popped big time. This thing went to run up 305. Again, though, look what happens. The story remains the same. You're selling the rip, you're rewarded here. Again, gives it all back. So, this is the market we're in. We're in the fade trade market. You're contrarian. You're having an awesome year. Think about Kenny's and saying it's great. He's contrarian. It's more contrarian strategies. You're a momentum trader. You're scratching your head and getting chopped up. So sometimes you got to adjust your trading. That's what we talk about in the STN room all the time. First step, when you're trading in any strategy, what kind of market are we in? Are we in a Momo market where stuff's just rampant and going? Or are we in a choppy market where stock's going back and forth? If you're in a choppy market, you want to be fading moves. That means selling rips, buying dips, contrarian style. That's why I've had a really good year as well in my trading account.
All right, let's go to our next news item. Major news overnight. Some mornings we sit down and we're kind of like thinking about what we're going to talk about on pre-market prep, and we're like, we're gonna have to work a little bit here. Today we did not have to work. The news helped us out for pre-market prep. Next item I want to cover, I'm going to pull up here. S&P announces some changes coming later this week on Thursday. S&P 500 is going to get CASY. Hologic, HOLX, is going to be taken out of the S&P on Thursday. So this is going to be implications tomorrow night, Wednesday night, because this is going to be prior to the open on Thursday. Also, DigitalOcean DOCN will be added to the SP Midcap 400, replacing Casey's. And then Broadstone Netlease BNL will be replacing DigitalOcean in the small cap 600. And I'll pull up the chart here in just a sec. But interestingly, something that was moving on this, of course, Casey's moved on this, but something that I thought was interesting that was moving was, look at the Marvell chart here. Marvell moving lower on this. Triple D, why did you think Marvell was moving lower on this?
Well, when you add in, and Marvell's been expected to be added to the S&P the last few times, they didn't get in again here. So I think that's why MRVL,
you're right.
Tank right on that news here. So, but these typically are buying opportunities. I actually did buy the dip on Marvell last night. We'll see how that works out. I'm still long it. That's a day trade. I will get out of that this morning as well. But Casey's, let's give some love to this stock, because this has just quietly been one of the best stocks outside the S&P for a long time. $200 back in 2023. It's now 747, and steady as she goes.
Woo.
She just seems to go up in a straight line. You get a little choppy pullbacks here, but for the most part, straight up. This is the third largest convenience store chain in the U.S. and a top 5 pizza chain as well, operating 2,900 locations, primarily in the Midwest and the South. They have pizza in theirs too, in the convenience store. Yeah, isn't that crazy? They're a top 5 pizza chain because they just sell it in the convenience store. That's it.
That is interesting.
Your Casey's, eat some of any of you ever ate Casey's pizza? Is it any good? I'm going to put it on my bucket list today. One of these days, I'm going to go into a convenience store and eat some Casey's pizza just to see if it's any good. That Dave Portnoy, he tried Casey's pizza. It's probably not that great.
He gives it a 2.1.
Yeah.
And check this out, folks. A little ticker banner running across the bottom of your screen right now. Thanks to Michael Feehan for wrapping up some of the notes that we make as we're planning pre-market prep. We're gonna start doing this where we're just getting a little ticker on the bottom. Maybe you can just get little updates that we're not given.
Thanks.
Simple stuff, man. Just simple stuff.
That looks great. Love it. Thank you, Michael.
We have Brandon Gulls saying Casey's breakfast pizza is legit.
Really? Okay, I'm gonna put the breakfast pizza on my bucket list then for Casey's.
There you go. So, thanks for that one.
Impressive, stock though. Now, is the S&P buying high? Don't they always? Finally makes it to the S&P 500, and it makes me not want to own SPY sometimes. But I mean, then SPY doesn't tank like the market does either. This is nice diversification here. So Casey's killing it, moving up here this morning. Let's look. Let's move on to the next headline because we went to the moon yesterday.
Artemis 2.
Any love? But we did. We went to the moon. I think we should talk about it because I was watching a little bit. See pictures. Pretty cool pictures on the other side. We realized the whole moon's not all gray. The other side of it looks pretty cool. Did we only see? That's the crazy thing is the way it works is that we only ever see the one side of the moon.
It's tidal lock.
You think it's like spinning there. You think it'd be like, but it's held there and
the
it's
gravity from Earth.
Like that. So we only ever see the one side. So we get out there, we take some pictures of the other side. Looks pretty cool. So,
and actually, the side that is locked to the Earth is actually the dark side of the moon. If you get to that other side, it's a lot lighter. Like
over there.
There's a lot more going on over there. So what did you think, Triple D?
I mean, we thought there could be the potential for some of these space stocks to move up. SPCE had a great day yesterday, but that was also because they announced that they were starting their launches again, and it's going to be $700,000 a person now, as opposed to I think it was like $300,000 before. It's up a little bit here, but really, there's Lunar or two, which I've long, but it doesn't look like it's going to work out here. I thought maybe there'd be a little bit of excitement around it. There was for a day or two, but it looks like now we're coming back. The mission though so far so good. They'll be back in 4 days. They're going to swing around using a slingshot method around the moon to get back. It's much like the Apollo 13 did back in the day when those when obviously the astronauts were all trapped and looking in trouble. They used the slingshot method. That thing's going to go 26,000 miles an hour on its way back. It's crazy fast, eh?
Whoa, yeah. What did they get up to on launch? They got up pretty.
Yeah, they get up to like 18,000, I think. And then I was just reading about it. And then they use the Earth to catapult and probably gets it going like 26,000 miles an hour too. Same thing, like catapult or slingshot. I'm saying catapult slingshot. So, that picks up more speed. So, yeah, the engineering and the physics is awesome behind all this. It's just impressive. So, congratulations, NASA. congratulations, on a mission that's gone well so far. Obviously, there's come back 4 days, so hopefully everything keeps going smooth.
Well, I'm Triple D. I'll take a little of the blame for, maybe your space trade didn't go so well last night. Because last night when we were in the STN room, I was like, Dennis, I was just in Florida and I was trying to make the case that this is like a mainstream thing. And when I was in Florida, we were all the way on the Gulf side. This thing launched on the Atlantic side. And when it was launching, I was in Florida and like 10 people, the family that I was with, 10 people like texted us and they were like, hey, can you see the rocket? Go look outside and see if you can see the rocket. I went outside. It was all cloudy. I couldn't see I couldn't see the rocket, which would have been pretty cool. But I'll take a little bit of the blame for maybe talking you into that one.
Fun though.
I'm glad you had fun.
To watch, fun to, obviously enjoy accomplishments here. And we need more of that. We need more like getting out there and getting out further into space and exploring and doing things, which brings us to SpaceX. We're still waiting.
Segue.
Yeah, we're still waiting. We haven't had an official announcement here. They're saying it's going to be as much as a $2 trillion valuation on this. I agree with Kramer. I've kind of said the same thing. I think, Tesla, I think it could get a bump initially here, especially if they get the option to buy shares. We don't know if that's going to be the case. If they don't, maybe it doesn't. Tesla is weak here once again, though. And I do wonder, and obviously it's breaking down to a new yearly low. I do wonder what Kramer said, and I kind of agree with it. Sometimes I agree with Kramer, sometimes I don't. I kind of agree with him here, is that Musk, I've said this before myself, maybe listening to the show again in the background, those producers, but, that Musk, the only way to play publicly Elon Musk has been Tesla. So now all of a sudden you have an option. So you wonder if some of those dollars invested in Tesla don't move over to SpaceX once it goes IPO. So I'm not fully convinced that this is going to be a great thing for Tesla stock.
And I just wanted to say real quick where we would get this, where I'm expecting this information on the SpaceX IPO. It's going to hit your SEC Edgar feed first. The Form S1 is going to be where that info comes from. So tune into your SEC feeds, ladies and gentlemen. We do have the Statman in the background, getting a nice drink of water to get that throat all loosened up. Let's run that wonderful Statman intro. Here we go. The Statman can do. Ryan, how you doing? How's your morning?
Good morning. My morning was fine until the last 35 seconds, and it got so much better. I just love this song. I just, it's just the best thing ever. So thanks, guys.
We're so
Good
glad
morning. How
that
you guys doing?
Doing well.
Good. Well, I know, I've got a lot of stuff to share. I just want to share my screen and get going.
We want you to get right into it here.
Absolutely.
We want to give you the stage. We love it when you come on. We just throw you the stage. Give us your presentation, and then we try to tear it apart.
Yeah, let's do that. That sounds fine to me. Let me see here. All right, share screen. I've done this once or twice. Where's the Michigan fans? He celebrating? Hungover? Where's he? Or
he's there. He was there.
Okay.
Yeah,
okay.
So he's still there. He's celebrating. He's definitely hungover, and he's there. And he sent some pictures last night, which obviously we'll share probably tomorrow here.
Okay. Good.
So he was there, enjoying it, having a great time. Him and obviously Lisa went, and his daughter went as well. So went to all 3 games. So I mean, that's huge. It's huge. It's nice to win a national championship.
Well, hopefully you see my Big Ten stat right now. Do we see that? We'll start with that.
Yeah.
All right. So this is in honor of the game last night. Again, thanks for having me back, guys. It's always fun to get to do this. Lots of stuff to talk about. So I will say, before I get into the goofy slide, a lot of these slides are things that we share with our financial advisors, right? I work with Carson Group, a $60 billion RIA. I work with over 500 financial advisors in 43 different states, and we're servicing almost over 60,000 families. So with all the crazy stuff going on, we don't always invest in if the Big Ten wins a championship or not. I just want to be very clear. This is a fun one to start with. But there's a lot of cool stuff I think that I'm sharing. Now, yes, I'm not a trader. I'm an investor. I'm more big picture. I think most people know that. So I'm going to do some big picture stuff. But we'll just jump right into this because I know I have
looks like bad news.
Yeah, I have 21 minutes. I have to stop in 21 minutes. Let's see how many charts I can do. So the last time the Big Ten won a championship, the S&P fell 3 years in a row. Yeah, no, it's silly. So there's some fun numbers we did with.
I'm scared it's going to be Joel's fault again.
Exactly.
Joel's fault.
You can blame the Fed, you can blame the president, you can blame wars, interest rates. I'm going to blame Joel with the Big Ten championship, because as we see here, history says be wary. But let's all right, let's go a little more serious now, because obviously a lot of serious stuff going on. I think it's kind of an interesting one, the way this week every week this year has played out, right? Strength early, weakness late. As you probably talked about on the show last week, the Thursday had been down 9 weeks in a row. Now, we were up last Thursday. Last Thursday, we were down a ton, and then we actually came back. But I think it's kind of the scenario where we have, okay, maybe the war is going to end. Maybe there's some optimism over the weekend. And then as you get later into the week, so people always say, what do you need to feel better about things? I mean, first things first, I want to get back above the 200-day. We're not that far away. Close above that on a weekly basis. Okay, that's a good start. But I'll tell you, not getting killed on Thursdays and Fridays would be a nice change too. So those are some things that I'm looking at. Now, I've shared this with you guys many times. So we looked at over 42 different major geopolitical events. Yes, some are more serious than others. They're all serious in their own way. I don't want to put it like that. But the reality is 1 month later, you're down on average. Sound familiar? Yeah, 1 month later, we're down on average. I mean, markets have a really funny way of adjusting to these things. As terrible as it is, the news, all the stuff that's going on, the uncertainty, 8 o'clock tonight, what's going to happen with bridges, infrastructure. Listen, I don't have the answers there. Nobody does. But the reality is markets have a funny way of being able to price these things in. If you can avoid a recession, you tend to be just fine. In our base case, we're not having a recession yet. Now, I know, Dennis, you're a huge fan of Tom Lee, so I threw this in.
Nice.
Tom's good. Tom's my boy. But I mean, sometimes Tom has good stuff. I mean, so this is interesting. I mean, this is something to shout out to Tom. But markets bottom early in conflicts. It is, I call this one of those, it is what it is. Yes, every time is different. I totally get that. But Tom looked at some major geopolitical events that we, the United States, were involved in, and check out, markets tend to bottom fairly early in them. So there's something to kind of think about as we face, obviously, all the stuff that's going on out there. Just a couple bigger pictures. I work with Sonu Varghese on our team, our chief macro strategist. He looks at all this macro stuff. So some of these slides are stuff he's put together when we talk to our financial advisors. But okay, well, what do we need for some good news? Well, we need the Strait to open up. Duh. We are seeing, if you get your magnifying glass we're looking for, magnifying glass out, we've started to see a little bit more activity out of the Strait. Listen, we're a long way from it. We get that, but clearly that's what we need to see to get a little more confidence with what's going on out there. I mean, what's the impact of this? Well, gas and diesel, right? And we don't think these are going to come back soon. I mean, I probably was on with you guys the last couple of months, and we said, listen, we think we might have more of an inflation problem than the market thinks. When we look at 178 core components of core PCE, the Fed's favorite measure of inflation, they tell us, almost half of those are up over 3% year over year. Okay, what does that mean? A year ago, it was 40%. So we're getting, we talk about market breadth, right? Broadening out. Well, we're actually seeing inflation broaden out. And this all was taking place before we've seen the jumps that we've seen in crude oil and obviously a lot of other commodities with everything going on. So this isn't like the end of the world stuff, but I'm not talking to you before, how we construct our portfolios. Yes, we've been overweight equities. I mean, this year, we manage about 14 to 16 different funds. Well, we'll keep it easy. We'll just say 14. We manage 14 different funds. We call the Carson house view models with real money with $8 billion in. We're outperforming our benchmarks by between 40 to 45 basis points after the first quarter. Yes, into this year, overweight equities, yes. But we've had some global exposure. The rest of the globe has been better than the U.S. Gold is still 8%. We've had some gold exposure. I said for a while, if you drop it, hit your foot and it hurts, you might want to add that. Thank God for managed futures. We've had a decent little bit of managed futures in there. We've had some real assets. We've got some different things we call diversify your diversifiers. 60% stocks, 40% bonds. We're probably 68 to 69% stocks, yes. So that other 31%, the back in the day would have just been bonds. Well, what have we seen since 2022? Bonds have not. Bonds make sense in portfolios, but I wouldn't say put 31%. That's why we're doing some different things in our portfolios that have really, really helped us. And I do still think it's a bull market. I do think equity is going to come back. But even in this choppy, volatile, I'll just call it that, choppy, volatile first first 3-4 months of the year, we've done okay because the other stuff has done well. And I still think that's a way to construct a portfolio. So let's have bad news. Usually I bring good news. Let's have bad news. You look at a 4-year presidential cycle. We are in the worst quarter on average. This is just on average, right? I mean, what's the old joke about the statistician? Put his head in a bucket of ice, feet in the oven. They said, how do you feel? He goes, on average, I feel pretty good. I don't know. Usually I tell that joke when people have a few beers in the evening.
Hey, I like it.
Anyway, so that's just something to think about. I mean, listen, I think maybe some of this was, we got the little selling ahead of time. We'll see. Got some other things where I think we're closer to a low than not. But at the same time, just be aware. And as I've laid out, I'm sure other guests, midterm years, yeah, they're not that great. First half of midterm years, yeah, they're not that great. I mean, those are just things that we know coming into this year. I got some other midterm stuff coming up in a second or two. Wait a second. Did I skip one? There. Okay, good news. And I get it. Seasonality, don't blindly invest in this. April is up 80% of the time the last 20 years. A decent month. It's pretty darn rare for March and April to both be lower. They were both that lower last year. Could it happen this year? Of course. Of course it could happen this year. But still, we're in that time frame where maybe we can get some type of a seasonal bounce. I think it'll be earnings. Earnings start up really soon. I got some earnings stuff coming up that I think could be a positive driver. But again, at the end of the day, it does matter. All about the Strait, all about oil, all about the war. I mean, that's truly what matters. That's why, again, stay diversified right now is what we are preaching. Not a short-term trader. I mean, there's other things we could do. But if you're looking at money for the next 1 to 3 years, we're saying don't be a hero now. Own a lot of different things, and that's what we're doing in the money that we run to kind of get through this uncertain time. Just the big picture stuff that I share a lot. Volatility is a toll we pay to invest. I mean, listen, last year, the stock market did really well, right? 2 years before, it did really well. But there were some volatile periods. In 23, we had that 10% correction late in the year. Obviously, last year had a darn near bear market, and a bear market and a lot of other stocks. If you look specifically, you'd see a 10% correction once a year on average. We just had 9.1. We just had 9.1% correction, or, well, it's called mild correction. Who knows? Have a little bit more, but I think it's important from a bigger picture point of view that this stuff happens most years. Average year sees a 14% peak to trough correction. Okay, there have been like 46 of those, or the last 46 years, like 24 of those years had a double-digit correction. 14 of those 24 years actually finished higher on the year with an average return of 17%. I guess if we're going to have some volatility, I'd rather be early in the year than late in the year. Because if late in the year, well, you run out of time to come back. Now, who knows? Maybe there's going to be more volatility late in the year. But those are just some things that we like to think about from a big picture point of view. Now, this is kind of interesting, and this stuff we knew literally coming into the year. Midterm years aren't that great. 17.5% peak to trough correction, the most out of the 4-year cycle. And midterm years on average have the lowest return. So we knew all that stuff coming in. We also know a second-term president, though, midterm years do really well. And I get it. This is like, okay, well, it's not second term in a row. I get it. This is asterisk. I totally understand all that. But still, historically, midterm years do better when you have a second president. So anyway, just think of that. But here's what we're sharing, peak to trough, and just check it out. Nobody knows when the market's going to bottom this year. I get that. But if you go 1 year off the lows of a midterm year, check it out. 1 year later, higher every time. What is it? Up over 30%? Yeah, up over 30% on average. And I've got it here. The median is what? August. Average is August. Median is later in September. That's when those lows happen. You ballpark your third quarter low. So just some things to think about that if this year's frustrating, then, hey, listen, from a bigger picture point of view, better times could be coming. So that's something to think about. Got this chart, my friends over at Bespoke. 200 days, a big level. We're flirting with it. I know we broke it on the S&P. Obviously, bad things happen. I looked at like the annualized return. So just the average day and then multiply it by 252. Gives you an annualized return. The S&P 500 is down like 23% annualized when it's below the 200-day and positive like 21% when it's above. So that tells us bad things happen under the 200-day. We need to get back above that. It was interesting. I do this for a living. You guys do too. The small caps, though, never broke the 200-day. I mean, that's it. Look at that bottom left. I mean, small caps just consolidate into it. Interesting, right? I mean, they haven't broken yet. Then small caps are up 3% on the year, right? S&P's only down like 3% on the year. That's another thing. S&P's down like 3% on the year. And I know, hey, it's not perfect. But listen, with everything going on, with the rally we've had the last 3 years, I don't think that's the end of the world is what, exactly. Pretty impressive. Yeah. So how many did I look at? 105. I looked at 105, 5% mild pullbacks. I ran this on, March 18th. March 18th is when the S&P officially went down 5%. So just ran some just fun with numbers, right? Fun with numbers is what I do. How often do you go to a 10% correction? And how often do you go into a bear market? I mean, bear markets happen, 10% corrections happen. We know that. But as you can see on the screen here, a good amount of the time, they just kind of don't go into corrections, and rarely do you go into bear market. Doesn't mean this time couldn't happen. I understand that. But again, just putting some context around it. Now, this is cool. I was listening to Sam Stovall on CNBC on Monday when I was driving. A big fan of Sam, and he mentioned this. Sam said, when you go a while, now a while is like 2 months, all right? Or, well, Sam went about a month and a half without, I think he went 40 trading days is what he went. So ballpark 2 months. When you go a while without correcting 5% from peak to trough, like we did this time, right? We peaked, I think it was January 27th or 28th, close enough for government work, but I know we were down 5% on March 18th. All right. So I took a look at that too. Well, first off, here's what Sam said. Since World War II, we've never gone into a bear market when it took that long to be down 5%. So I thought that's interesting, because usually, I mean, think back to March 2020, right? Or April 2020. It took 4 days. You can see here, it took 4 days to go from an all-time high to down 5%. In other words, I looked at 11 bear markets since the 50s. You tend to be down 5% fast. In other words, trouble starts kind of fast. Now, this time could be different. The foremost dangerous word, Sir John Templeton, but it has taken what did I have the number there at the bottom? 35 days. So that's about 7 weeks to go from the all-time high to -5. So it'd be extremely rare. In fact, it's never happened before to wait this long to correct 5% to go into an eventual bear market. So again, just some things to think about here as we think about what's happening. This is a good one. I've shared it many times, but I like to share it again here. I've added a few more bells and whistles to it. The colors actually. Where this This bull market is 3 years old. It turned 3 last October. We know that, right? It is very, very rare for a bull market not to get to its 4th birthday. Once it gets to the 3rd birthday, you can see in the black there, we've had some bull markets that were amazing, but didn't quite get up to 3 years old, like the one after COVID there. Market like doubled or something like that real fast, but it never got to 3. And then we also remember what happened in 2022. So only once, that's 1 out of 8 times in the 60s, that's the green one there, did it get to its 3rd birthday and then not get to a birthday with 4 candles on it. The incredible thing, if you look at like the last 5 bull markets that made it to this point, the average length, this goes back like 50 years, is 8 years. The shortest any of them went is 5. So, just again, fun with numbers, but putting context around the idea that this bull market maybe is not as old as people think. And honestly, after the rally we've had, it's a midterm year, all the crazy stuff going on. I mean, crude oil spikes, all this stuff, yields, the Fed's now hawkish, apparently, all this stuff. That the market is truly, in my opinion, just kind of, biding time. I mean, it's just correcting through time, which I think is potentially a positive, bigger picture. A little more technical, probably for this crowd. Look at 4 different things. You got Mag 7, we have Bitcoin. What else? We have the transports and emerging markets. Previous resistance should be support. So I learned it. There's different time frames on these, and all these are kind of different last I checked. But all 4, like 2 weeks ago, were at very, very big levels of support. Well, last I checked, all of them have bounced where they're supposed to. So if all of these were to break, or even 1 or 2 of them were to break, that'd be more concerning, but the fact that we're holding here, again, I think are positive. Also look at small caps here. Small caps doing something very similar, where it's finding some previous or some support near previous resistance. So again, so far so good on these. Let's see, I got a couple more we can chat. Earnings season's here. Fundamentals, I mean, listen, this is wild. Look on the left. I mean, earnings so far this year, everybody, 12 months estimates going out to the start of the year up over 7%. I mean, that's not consistent with like a recession or a bear market. Not saying it can't happen, but it's not. Then on the right, you have profit margins. So profit margins and earnings continue to improve to the upside. I think something like 111 companies in the first quarter increased their earnings guidance, most we've seen in like 4 years. I mean, the market's the market, but the way I've learned it is, listen, the dual tailwinds of this bull market are earnings and profit margins. They're still solid. So those are reasons, again, to think that when we get through this, when all is said and done, we still have an upside target of 12 to 15% on the S&P 500 this year. I hate giving targets as a strategist. I'd rather look at, like, people think, oh, you're bullish. Yeah, but we managed $8 billion and we outperformed our benchmarks and most of our peers in the first quarter. So just because you say one thing and people forget there is money involved in managing it, but the reality is we do expect to see equities do pretty well, or we wouldn't be overweight equities where we are right now for the remainder of this year. Not well, who knows what the remainder of this year will bring, but where we are right now, we are definitely still overweight equities. I'll just quickly on payrolls. I mean, a lot of people think the employment backdrop's falling apart. We did have a pretty good number the other day. We're not seeing, it's a low hire, low fire world, right? If people are losing their jobs, that's not good. That's bad for the economy. That's very clear, I think, but we're not quite seeing that. It's a low hire, low fire. But I want to share this on the right, because what have we heard for a while? AI is coming for people's jobs. Makes sense if you think about it. All we're hearing, specifically young college people. Well, on the right, or college age people, on the right, that's 20 to 24-year-olds unemployment rate. About 4 or 5 months ago, it was 9.2%. It is tanked down to 6.4%. So now that people say, well, you know, there's this or that, or maybe they're just becoming Uber drivers. I don't know. I just know that the unemployment rate, at least for people that are saying are supposed to be really impacted by AI, and AI is coming. I'm not saying it's not.
It's not here yet.
Yeah, just kind of interesting, though, that to the point of that, just a couple more. Check on sentiment. Our friends at The Economist, they're always quite optimistic. You got to love The Economist, always very optimistic. But, you know, we are seeing many places sentiment is in line with the most bearishness we've seen in history. I mean, literally, we've seen hedge funds in the last 6 months selling. This is according to Goldman Sachs Prime Book. Most selling in a 6 months period since a 100-year pandemic and after Liberation Day last year. We just saw 8 weeks in a row of, which one did I share here? Bulls went down 7 weeks in a row, one of the longest ever. We've got bears all over. Put the call ratios are finally starting to spike. Skews are strong. Now I get it. You know, some of these stats were around almost a month ago. And how's the market done? Yeah, it's kind of gone lower. So I think one of the reasons we have this slow motion, crash is the wrong word, but I'll say it. It feels like a slow motion crash because everybody's hedged. Everybody's expecting it, right? If everybody's thinking alike, somebody's thinking General Patton. Not saying the market's not going down because it has been, but it sure isn't doing. If you tell me crude oil does what it just did, what like double or whatever the heck it did, all this stuff, yields going higher. Now the Fed is more likely to have a hike than a cut. If you would have told me this 6 weeks ago, if you would tell me the S&P is down like 5 or 6% from the all-time high and down 3% for the year, I'd say, yeah, I'll take that. You know, I think most people, I would assume we'd be down a lot more, to be honest, but we're not, right? Shout out John Murphy. I know a lot of John Murphy fans here passed away recently. You know, the message of the market, to me, the market's kind of saying, listen, things aren't as bad as they're telling us, and maybe we can get some type of resolution. The Fed, don't need to say too much more. The Fed, no cuts are coming. I mean, no cuts are coming, right? When I talked to you guys a month or two ago, we thought cuts were coming. Well, they're not now because inflation was broadening out, but we've actually managed our money that way. We've positioned for a world of higher, we call it more volatile inflation, not necessarily high inflation, but more volatile inflation. When you have more volatile inflation, you own stuff when it hits your foot and it hurts, or own a little more managed futures, maybe a little more cash. We have short duration. We have bonds. Listen, you manage a lot of money. You have bonds. But we have shorter duration bonds, less bond exposure in there in general. So that's kind of how we see that. And then the last one, times change, so do markets. Listen, nobody has the answers, including anybody. Nobody has the answers. But this is kind of cool. I mean, you know, how was our economy in 1900? Well, it was mainly railroads, right? Check it out on the left there. How is it now? Technology. What's it going to be in another 100 years? I have no idea, right? But we adapt, we change. These things change. But I think the key concept being that this is still a structural bull market, in our opinion. There's still positives, but hey, we're definitely more. When I came out with you guys 2-3 years ago, I said, listen, go all in U.S., be strong U.S. U.S. looks good. I'm not so sure now, right? We've got exposure all across the globe in different places. I'm not trying to play hero with the world that is very, very uncertain. So I'll stop sharing. Hopefully that all made sense. I've got what time is it? I've got about 3 minutes, guys. Hopefully that's okay. But thank you as always for having me. What do we want to talk about?
S&P earnings supposed to climb. Your projection's still to climb. Do you know where the multiple is right now? Because obviously always a moving target. Have you looked to see like where we are comparatively speaking? Like I know in some, you know, peaks we've been as high as 27 or 28 times earnings. Yeah. You know, and then in the troughs we've been as low as like 9 or 10 times earnings. Like where are we and where are we? Like
I think we're like 21-ish, right around 21.
So kind of in the middle.
Yeah, in the middle, but again, it's like more relative where we were a couple years ago. I mean, if we'd done this 6 months ago, I mean, one of the worries, market was pricey. There's no doubt about it. Market was pricey. As I just said, earnings estimates are up 7%. Price is down, 3 or 4 or 5%?
Yeah, so that makes P come down.
So, yeah, there is some cheapness. And we actually added some, I don't love you to take Dennis. And we added some software. We added I can't say individual names.
I took some guts.
Pretty popular software ETF. We did that about 5 weeks ago, actually. And again, it's more of a strategic look. Like, we said, these things are getting killed. I just remember last year. a year ago right now, we're talking about Liberation Day, but let's call it 54 weeks ago. We're talking about DeepSeek, how DeepSeek's going to crush all of tech and no one's going to buy anything on AI infrastructure anymore. Yeah, that's what's laughable now. And I know that, listen, if you're Adobe, I mean, does anyone, not a recommendation, but, we've got a little thing on our phone now that makes everything from Photoshop now, so there are certain companies that are in trouble. I mean, that is for sure. But at the same time, we do think there's some opportunity there, and it's still where the earnings growth. I mean, so like I mentioned, earnings estimates are up 7%. Like most of that is from tech and energy. Okay. I mean, tech is still doing well. And I get it. I've done it a long time. Sometimes cheap things are cheap for a reason. I totally get that. But when we look at tech, I mean, we back in November, probably the best. I've been at Carson for almost 4 years. This is probably the best tactical trade we've made. We added some telecom back in November. Now, we didn't look at it like telecom was about to go vertical, about 20. I mean, Verizon be the hottest stock in the market. Thank goodness it's happened. It's really helped us. But we looked at it like an ulterior, okay, that's part of tech, but we don't want to be so top heavy and kind of the high flying Mag 7 names. At the end of the year last year, when I saw that Time Person of the Year with all the 7 leaders of AI and Mag 7, all that stuff, I said, boy, that's a pretty darn high bar. And then look what's happened. But then you look at something like telecom, nobody's even still talking about that, but that's the darn near strongest group out there. And it's still part of technology last I checked.
Ryan, fantastic stuff as always. I mean, you blow us away. So much information in such a little period of time. We got to get more time for Ryan next time. Even 20 minutes maybe doesn't cut it.
I know. Well, you guys are done in 5 minutes, right?
Yeah. We'll keep you on. What else you want to add? What else you got?
I have to go talk to BNN up in Canada in 5 minutes. So once this signs off, if anyone has it up in Canada, I'll be on BNN.
You talk nonstop. I see you on CNBC. I see you everywhere. Do you ever get a chance? What do you do? Like to rest your voice?
I have a face for radio. I have to give the people what they want. So listen, I do have to go talk to my friends in Canada. Guys, thank you. I'm a huge fan of the show. I'll see you next time. Take care.
Have a good day. Later.
See you, Ryan. Thanks.
All right,
I mean, so much information there, obviously. The stats are the stats, and that's why he's the stat man. And it's good, sometimes to get grounded because here we are, another headline here again. Here we go again, man. Here we go again. Cancel orders. Third time I've canceled all orders this morning.
Futures popping 13 points.
Third time this morning.
Chat, what do we got? I'm looking around. I don't see anything yet.
Keep an eye on your USO. Obviously, we see futures popping, USO chopping around. This is going to be what we got. This is our day. Shopping around. It's crazy how much we chop right now. Yeah, like 3 times in our 8 o'clock show, we've had a headline that's been market moving. And that was again. So you're going to see more and more of this today. This is the day we're in for here, folks. So, we can, trade, again, we can look at stats and, long term. We're usually okay. We've always been okay long term. So it's hard to bet on the end of the world here. But, in the short term here, it's all uncertainty and it's all about the next headline. And, something just happened because the S&P futures popped up quickly. Now we're starting to leak it back here again. But, incredible movement, incredible moves. And the fade trade works again. I mean, right there. Bang, we pop up, right back down here. Somebody gets excited about something. Oh, yep. Oh, somebody's nervous about something down. Oh, right back up. The algos have got to really begin chopped up here on some headlines too. We talk about, it's humans, but it's really algos that are, ripping them higher and then taking them down. And we can think the algos are all making money. I'll tell you, some of them do. The good ones do. The market-making ones do. The ones that are fading do. Who are those? You got your Virtus and obviously, your Citadels you get a lot of credit to. They're market-making on the other side. And you're buying those rips, they're selling it to you. And you're selling those dips, they're buying it from you. That's where they're making money as market makers there. But there's a lot of other algorithmic traders. There's going to be more that keep coming on the board with AI that, quite frankly, just aren't very good. So we're not talking about the Citadels and Virtus of the world. We're talking about the little guys, that are coming in, running algos. Oh, yeah, I got this figured. Oh, yeah, my system's buying. Oh, it's not. So I think there's going to be still a lot of opportunity for human traders in here for a while anyways.
Let's fit in a couple quick ratings. You cool with that, Triple D?
Yeah, let's do it.
On screen, I have the ARM chart. ARM Holdings this morning getting a downgrade at Morgan Stanley. Are you interested in a little bit of color here, Dennis?
Yeah. Give us a color, sure.
Price start going up to $150. Actually, seeing this color on the fly. Thanks to the fly. Morgan Stanley says the company's transition into chip making is a, quote, structural evolution of its business model. amid the emergence of agentic AI. While ARM's strategic positioning and early design delivery have been exemplary, its commercial ramp will take time. Morgan Stanley adds that near-term execution risks temper enthusiasm. Morgan Stanley believes end market softness, exacerbated DRAM supply constraints could stymie ARM's near-term growth. What say you, Triple D?
Valuation's always been an issue here. I mean, the story has carried the stock. Story's been pretty good this year. What we've been talking about is that ARM has been one of the best AI places to be this year. So they come in here, poo-poo on it, and now like we've got this nice little uptrend going. Recently you could probably try to draw it, and it's going to breach it here this morning. So that's somewhat concerning, but there is great support down there at 140. You had a low there just 4 days ago, and I like the old Ryan Detrick old support, old resistance becomes new support. You topped out at the 140 area in December multiple times, so naturally you think maybe some buyers emerge in that 140 area. I wouldn't throw the ARM out here. Do I think, like even this downgrade in itself is not overly bearish. They got a 150 price target on it. So
they raised
it's
the
not
price
like a sell rating where they're saying get the hell out. The worst is yet to come.
Yep. Wingstop here this morning.
Yeah.
Pull up the 5-minute chart on this one so we can see a little price action here this morning. Wingstop this morning getting a upgrade to buy at Citigroup. Thoughts on Wingstop? I think you kind of were intrigued by this call, Dennis. Is that true?
Yeah, like I'm looking at it, obviously a contrarian call. They waited for a strong candle yesterday, so they come on here today here with Wingstop, and the stock's trading up, 1.3% here. I mean, this is a story of valuation here, and what we have saw is, Wingstop had the growth going, and we talk about this all the time. When the growth is going up, they can't stop buying these stocks. 2024, it's like, oh, the growth is so high, who cares about the multiple? Once you get one quarter, that first print where the growth starts to slow a little bit, get the hell out. Because what happens is, obviously, you start to see multiple contraction. And that, unfortunately, is what has happened with Wingstop. It's now 27 times earnings, was trading 50 times earnings at one time. So it's come down substantially here, all multiple contraction. The company itself still doing very well. Just people were just paying too much for those earnings dollars here.
Yeah.
And that's come back in. Now, maybe at this point in time, it's gotten to a point where it seems like when these growth stocks start coming back into their 20s, they do start to be attractive again. And are Wingstops going away? Probably not. There's lots of places to get wings, but I've never ate a Wingstop, but I hear it's pretty good. So, I don't mind the call here. It's a bold call. Stock was definitely way oversold. It went from 300 at the top of February down to 150, cut in half in 7 weeks. That's one of your ugliest stocks in the market here in that short period of time. So maybe it's due for a little bit of bouncing.
I want to do one more real quick because I think this is a pretty darn contrarian call. Bank of America adding Microsoft to its US 1 list. This is like a focus list where they see near term. Usually it's 30 days. Goldman's is 45 days for their list. Upside in their names. They also added Spotify, SPOT, and also Viking, VIK, to their US 1 list. But what do you think about this BABA call on Microsoft here, Triple D?
If you can zoom in to the last 3 weeks, just zoom in. I don't know if you can show me a shorter chart here. You'll see what I'm seeing here.
Let's do 60-minute chart. How about that?
That's good. You got a little cup and handle going on here. So you can see the bottom of it. Yep. And now you got a handle happening. So it's a bullish pattern. If we get some type of ceasefire here, this is going to resolve to the upside. All the technical analysts say, see the cup and handle, we told you so. But I mean, if, we get, escalation here and it goes down, then they won't mention this pattern at all. But it does look pretty. From a chart perspective here, you got a little bit of cup and handle here happening. You have a massively oversold stock. You have a stock that is cheap as it's been in 20 years. 19 times forward earnings. This is as cheap as it's been in 20 years. Is it deserved? I think so. I think it is deserved because I think there is competition coming in for software from everywhere, not just from one other company, but from everywhere. Is Microsoft Office products under attack? You betcha. So there's a lot of reasons why this multiple has contracted. The question is, does it all happen? Ryan Detrick saying going out buying some software stocks. Is the AI disruption happening today? No. Are the earnings for the quarter going to be fine? Probably. I don't think we've seen a lot of disruption here yet. It's what's coming in the future. It's like the jobs numbers Ryan was talking about here. We're not seeing any people lose their jobs to AI here yet. It's in its early innings. I said AI, at one point in time, I said it was in the second inning. Now I've changed my mind after seeing and working with OpenClaw and working with you guys and working, just seeing what's happening here. I think AI is in the first pitch of the first inning. So it is so early here. I think by the second or the third inning, you're going to see some massive job losses here. How quickly we get there is the question. Are we there by the end of the year? Are we there by the end of next year? I think we're there. I think we start losing jobs here next year. I don't think it's like, I think you're going to see some software jobs, gone here, like in the next little while here. And again, I've been saying software, but, I respect, that when you've got everybody working, we're looking like your software, your software developer right now is probably in more demand right now than they were last week, even because there's other places for them to go. Like we were looking for software developers to help us, on certain stuff as well, just to, like tweak stuff and to debug stuff. So I do think, that there's going to be less need, because I think, all of a sudden, everybody starts becoming a software developer as the AI software in itself, as OpenClaw, as new stuff gets created, gets better. So, I mean, the path here is quite obvious. The path here is that, hey, you can take somebody who knows nothing about programming, nothing at all, and all of a sudden they can make stuff, make software. Now, a lot of that's going to be junk, but you know what? There's going to be some pretty cool stuff too. And I do believe some of these software engineers that are getting laid off, potentially from, Meta, if they do, obviously from Block, coming elsewhere, I think they're probably looking, hey, let's go, get our open claws going and make some stuff here and sell it ourselves. So I think these people getting laid off, these software developers are getting laid off, could actually go into building mode here right now because they're way better than me, who doesn't know anything about, building and even to debug thing here. So, I mean, I think they're in a great position here right now, at least for the short term. So get out there and start building. I think that competition, though, for your software company is coming from everywhere. I know everybody talks about the moat and saying, oh, it's the connections, it's the relation, it's unbreakable here. I don't believe it's unbreakable.
Dennis, I think you just gave Ryan a little run for his money right there. That was a good one to end the show.
I love Ryan's stats. I think when we're talking about jobs, though, none of that has happened yet. So obviously, that's one thing about stats. It's always backward looking. So, as a trader, that can be very helpful because we say, hey, we've been here before. This is the likely outcome here. We've never been through AI, though, before. So we don't know. I don't think there's anything like to look at and say, oh, for certain, this is going to come back and the market's going to go back to all-time highs. I do believe the war is going to get a ceasefire eventually, and we do have that potential to go back to all-time highs in the short term. Next year gets dicey for me. I'm more worried about next year than this year because I just think job losses are coming, and I think the market's not prepared for it.
All right, great way to end pre-market prep here. Triple D and I are going to switch over to our STN room. There's a code on the bottom of the screen right now. If you want to come check us out, please do. I want to say thanks to our wonderful pre-market prep chat. I want to say thanks to our wonderful Statman, Ryan Detrick. Thanks to you too, Triple D, for being a great co-host here this morning. Good luck out there today, folks. We'll be back tomorrow morning with our Wednesday episode of Pre-Market Prep.